business cycle, but also peak in home prices and stock prices in 2006 and 7. And then the financial collapse came, right, that basically torpedoed stocks and real estate. We were in basically a recession from 08, 09, 10, and then you can see, starting back in here, it bottomed in 09. This is the stock market index. This is the Standard & Poor's 500 index, stock index. And then we started to recover. You can see in 10, 11, 12, 13, 14, 15, and we broke through the 06, 07, and the 2000, 99, 98 stock market peaks, and we broke into the upside. And you can see it hit 18,000. It's been pretty volatile. We don't know what direction it's going to go because there's no support lines in here, right? It just went straight up for basically 4 years with really no volatility, no correction, except for just recently in January. So what you need to watch is you want to watch the yield curve, okay, and I'll walk you through it a few times. And just watch how it shifts. So as you start to move towards these cyclical peaks, not only in the business cycle but in the stock market, you are going to see the yield curve start to shift up. And then right before these two peaks, the curve shifts up, flattens out, and then inverts, and boom, we're in a recession a year later. Okay, go ahead.
And you just went to the site and pulled that up?
Yeah, I went to the dynamic yield curve. This is the most recent yield curve. So the one, if you watch the video, is probably maybe 6 or 9 months old. So this is the most recent, okay? And again, what you want to do is you want to watch the behavior of the yield curve and watch its impact on stock prices. And you're going to see that when interest rates are really low and the yield is flat to the downturn, cost of capital is really cheap. And stock prices appreciate significantly. When the Federal Reserve sees that the economy is overheating and is concerned about inflation or asset price bubbles, they will start to sell bonds on the short end, driving down prices and driving up interest rates. And then actually the interest rates on the short end, because that's where the Fed controls the money supply in the bond market, it will invert. So really the movement is on the short end, okay? Because that's where the Fed is manipulating the market. So imagine if you were a fixed income manager who was buying and selling bonds as a portfolio, and most of the maturities of your bond portfolio were short maturities, you'd be dealing with a lot of interest rate volatility, and the value of your bonds would be moving constantly. So you would have to hedge them. You'd have to hedge or put in risk management strategies. Okay, so I'm going to hit automate here, or animate, and it's going to start to move. So it's going to go from 2015, and it's going to go right to here, and 98, 99, 2000, which was the peak.
Can you turn the lights off just to make it a little easier to see?
Yeah. Is that good?
Yeah, here we go.
Okay, and I'm going to walk you through it. I'll walk you through it a few times because this then gets showed up over here and then flows all the way through into the investment decisions. Okay? And then we'll talk about real options. So as you can see, we're moving towards the peak of the stock market and the bond and the economy, and you can see the yield curve is really high. It's normal, but it's now starting to flatten. And watch, it'll invert, right? It's going to invert any minute, and then all of a sudden it's flat, and now inverts, and boom, we go into a recession. And then as we start moving into a recession, the Fed enters the market, starts buying up bonds, driving up bond prices, and starts to drive down interest rates. And is basically trying to keep the markets and the economy from collapsing. So they're just printing, buying a ton of money, buying lots of bonds with print money, bidding up the bond prices, and driving down interest rates. And look how steep, it's normal, but look how steep it is. The curve is, they are just buying like mad to try to get the economy to bottom and the stock market to bottom. So as you start to move into the recovery and the growth phase of the business cycle, you're gonna start to see the yield curve, and look, it's already happening, is starting to move up. So the Fed is starting to sell bonds in the marketplace, driving down bond prices and driving up interest rates to cool the economy and regulate the economy. So as you can see, interest rates are rising, the curve is starting to flatten a little bit, and then watch, like right when it gets here, it's already flat, it's gonna invert, and then literally within a year, boom, we're in another recession. Okay, so there, so you can see it inverts. So it inverted, and this was about a year before it inverted, and then hit its peak. So there, it was pretty coincident, right? It was a very short time. It inverted, it peaked, and went into a recession. In this one, it inverted, and then peaked a year later, okay? Then we were in the financial collapse, and the Fed was doing everything to keep the economy from going into a depression. So it drove interest rates basically to zero, and really started to buy along the curve to bring down long-term interest rates, because that's where firms borrow from for plant and equipment and for real estate development. So they were really trying to push down the cost of capital in longer dated maturities to bring down the cost of capital. And as you can see, in 11 and 12, the short-term interest rates are really low. And then what you'll see is all of a sudden the long end will start to move down. So the Fed now has moved up the curve and is starting to buy bonds on the longer dated, longer end of the term structure, and really drive down long-term costs of capital to get people to consume and businesses to invest to stimulate the economy. But as you can see, we've already broken through the historical resistance lines, and then the stock market just takes off because the interest rates are so low. There's so much money out there. People are borrowing and buying stock, and it's just driving up the stock market. And then you'll see, and it probably won't even show up, where the Federal Reserve raised interest rates. It had an impact on the stock market, but still, interest rates are extremely low based on historical standards. So if you were forecasting stock prices into the future and you looked at the yield curve and how flat it is and how low it is, where do you think stock prices are going to go in the future? Where do you think they would go? What? I'm just saying interest rates are really low, right, based on historical standards, and the stock market is really high based on historical standards. And if the Federal Reserve decides to continue to keep interest rates low, where do you think stock prices are going to go? Probably going to continue to go up. Okay? Probably going to continue to go up.
So are you saying that when the short end goes higher than the long end,
That's right.
that's where you have a problem?
You usually see the stock market peak, right after that happens, and then we fall into a recession. And the stock market drops significantly.
And what's the percentage on the side? Is that the key borrowing rate, or what is that?
This is the S&P 500 index.
On
So
the other side, on the left side?
This is the yield to maturity. This is this curve right here. So it's maturity of the bonds,
right,
and the interest rates. So these are the interest rates on the bonds for these maturities.
So once the interest rates on the short-term bonds gets higher than the interest rates on the
on the long-term bonds,
yes,
then you usually see a peak in stock prices, and you start to see stock prices start to, it's a leading indicator. It's a leading indicator.
thank you.
But this recession could be the first time where this yield curve model breaks down. And if you're using this yield curve model in your models, it could break down.
Well, and that wouldn't really be surprising, right? Because
It
what
would.
happened in 08 was unparalleled. The level of money that they flooded into the system
Exactly.
was unparalleled.
Yes.
So for that dynamic to break down, it's possible that in some way that's connected.
And this is the issue that we're dealing with, and you're dealing with it because you're studying all these models, which are basically married to this theory. And if the theory breaks down and we fall into a recession, and the yield curve never inverted, then you can't use the yield curve as a predictive indicator to manage your portfolios. Okay, because a lot of the theory and the data assume these natural dynamics embedded in the model, the way the models are constructed.
And the lag on that is 12 months, 18 months?
This one, it was like a few months before. Here it was a year.
Okay.
Okay, so the question is, if we're going into a recession, why hasn't the yield curve shifted up and inverted yet? Theoretically, it should have. Except that the Federal Reserve probably is keeping interest rates lower longer than it probably should. It's creating asset price bubbles.
Yeah, because then the banks suffer from those low interest rates.
Yeah, and individuals do too.
Yeah.
I mean, what we don't have here is what happened in Japan and in Europe, where they actually drove interest rates negative, okay? And that might be the next reality that we're gonna have to manage, is how do we manage negative interest rate environments? How do we manage our balance sheet? How do we manage our stock bond portfolios, our derivative portfolios, and our hedges in a negative interest rate environment? That's the next new reality.
I don't understand how an interest rate could be negative.
Because it means that the Federal Reserve is printing a lot of money
Okay.
and driving bond prices well beyond their par value, shall we say, and driving the interest rates negative.
Okay.
Okay, so basically, if you're a bond investor, you are getting a negative return. You're not being compensated. You are actually paying them to buy their bond. Now, that's pretty messed up, in my view.
But the reason that you do that is because if you just left it in cash, that alternative is worse. Right?
Well, yeah, because the inflation
The
and
inflation
something,
erodes it.
but you know,
That's why you would accept that negative return, because it's the lesser of evils.
it's a bad evil. And what they're doing is by driving interest rates negative, it's forcing the banks to lend because they're getting negative returns on their bond investments. So it's trying to force them to lend. Okay, and it's making them pay the Fed for holding money at the Fed. So it's a very excessive and severe monetary policy tool that only Europe and Japan just did it like a week ago. And the US has said, we will do negative interest rate policy if we fall into a recession. And bond investors will be hurt, banks will be hurt, savers will be hurt. There's a lot of damage that could be done if this happens, and it probably will.
I have a question on this. When we get into the negative interest rate, is that not, what is that hurting the consumer market?
Well, if I have
Isn't it
savings,
easier for me to like borrow money?
yeah, it's on the consumer side, the lending rates theoretically will come down.
So when it happens, if there are more loans going, would that get out more, suck out more cash?
Theoretically, that is that's the logic. Is that if interest rates are negative, then basically credit card rates and mortgage rates will be driven down even lower, and business loan costs will be even lower,
Right.
and people will borrow more and consume more and invest in real estate or whatever. That's the theory. That's the
Okay.
theory. Okay, but it's only been done in two countries, in Europe and Japan. We don't have a history of this. Okay, so it's fairly unprecedented. It's the reality in which you're operating, as managers. So let's talk about